You're listening to The Cash Podcast, creating affluence, success, and happiness with your financial surgeon, Adam Koos, President and Portfolio Manager at Libertas Wealth Management Group at libertaswealth.com.
Hello, everybody, and welcome to our annual series that we call Nerd-vember. It's November, and every year we do a series we call Nerd-vember to get a little bit more detailed, a little bit more into the weeds when it comes to technical analysis, charts, tables, investing in a little bit more savvy fashion, if you will. And probably only about, 80, that was going to be the inverse. It's 20%. 20% of our clients probably will watch this, if that. And so you might be wondering, why in the world are you doing it? Well, it's the same reason we only have a quarterly scouting report, market update, and halftime update. Our monthly market brief, which we send out and try to keep as short as possible. In a perfect world, it's one page, including one chart. That's about as technical as we get. So the purpose of that is to obviously satisfy the taste buds of those people who are a little bit more savvy, sophisticated, and want to get a little bit more into the weeds when it comes to the details of the stock market and investing. And so every year, once a year, during the month of November, we do Nerd-vember to nerd out a little bit more and get into those weeds. So today we're going to be talking about time frame. Should you be selling or buying stocks? And the answer to that question is it depends, and it depends on your time frame. And I think this is one of the biggest mistakes that new investors make. And I shouldn't even say new investors, but even veteran investors. When I say veteran, I don't mean they're analysts. I don't mean they're certified or professionals in the industry. What I mean by is somebody who's been managing their own portfolio for 15, 20 years. I would consider that person to be, a retail veteran, or, a veteran in being still a beginner technically from a knowledge standpoint, perhaps. But I'd say they're probably a veteran in terms of the amount of time they've been investing their own portfolio. So when I look at, people who've been doing things for a really, really long time and managing their own portfolio for a long time, they're still subject to a lot of the mistakes and pitfalls and things that can cause them to lose a lot of money and get really frustrated. And then, of course, they don't want to blame themselves, but they want to blame the research, they want to blame the analysis. Because it's pretty, it's like having a gambling problem. I hate to use the analogy, but when things don't work out with your own money, there's a lot of emotion attached to that. So what we're going to do today is we're going to talk about time frame and how important it is, and really how it's the first thing that every investor should decide before they even think about, let alone click the button when it comes to buying or selling any investment. You have to do this first. You have to know your time frame. But we always start with a quote. Today, this is Sir John Templeton. He said, "The four most expensive words in the English language are, 'This time it's different.'" And the reason why those are dangerous words is because it can cause investors to decide that they're going to sell investments before they should. It can also cause many investors, maybe many more in some cases, to not invest their money when they should. In other words, maybe they should have invested years ago, but they just keep kicking the can down the road and procrastinating because they don't want to deal with it. They think that this market's going, it's going to go down. It's because of Russia, and it's because of Brexit, and it's because the flash crash. I can go back and pick out 3 or 4 events that occur per year that would cause people anxiety and give them several reasons not to invest their money. But again, it can also cause people who are invested in the market in a diversified portfolio of stocks, bonds, commodities, what have you. It can cause those people to sell too early too, because your time frame, again, as the whole subject of this podcast today, is so important. And when I talk about time frame, what I mean by that is there's several different types of time frames, and we could get into the weeds in terms of micromanaging this down to a T. But the first time frame that we'll talk about is day traders. Now, most people don't realize that day traders typically are looking at daily, minute-by-minute charts. So they're looking at one day, and they might look at a 1-minute chart. I know some might look at a 3-minute chart, but they're looking at the daily movement through intraday and throughout the day of any stock. And they might look at Forex, they might look at commodities, it just depends on what the individual in question happens to be trading. But a day trader is somebody who typically looks at a chart throughout the day, typically on a 1 to 3 minute time frame, and they also oftentimes will go to cash at the end of the day. So they don't even hold investments overnight. They start at the end of the day, like it's the trading session's open, it's time to invest, and then by the end of the day, they sell out and they go to cash overnight, and then they start over again the next day. So that's a day trading time frame. A swing trading time frame is a little bit longer, and that's how we're going here. We're starting with shortest and going to longest. So a swing trading time frame is more, it's also a daily, but we're looking at more than one day. Typically we're looking at 1 to 3 weeks, but it can be, just a few days. The holding period doesn't have to be 1 week in length. So a swing trader might own an investment for, go in at say $50 a share. They might have a stop at we'll say $49.75. And if it crosses below $49.75, they're out 2 days later. They also might buy a stock at $50 a share, and then they find out the trend kicks in, it holds, and they might own it for 3 weeks, and they might sell it at 52, 53. So they're not looking typically for big, huge gains. They're looking for smaller gains, and they're looking to manage their risk on a very, very short-term time frame. So like a 5-day moving average, or the direction of the 5-day moving average might matter a lot to a swing trader. And the 5-day moving average is just the average movement of an investment over 5 days. And then they compare the price to that. A short-term trader, a short-term time frame, would be something like 1 to 6 months. I've heard people say 1 to 3. I've heard people say 3 to 6. But I'm just going to say it's between 1 to 6 months. 6 would be pretty long. And these people might own investments for, buy at $50 a share. They might have a stop loss of, say, $4 to $5, which would be 8 to 10%. And then from there, they hold on to the position until it crosses below that line in the sand, typically on a daily basis. They're not waiting for the end of the week. If it closes at Wednesday night below, in this case, say $46 or $45 a share, they would sell and they'd walk away and they'd take the cash and find something else to buy. Or if they're only trading that investment or a handful of stocks, they might go and wait for that investment to cross back above a certain line in the sand and then buy it back. Or another, it's called trading up. They might trade up into that same investment. So that's short term. Intermediate term is more like 6 to 12 months. Full disclosure, this is my time frame. This is the time frame I implement for our clients. I feel like short term for me is a little bit too short for our clients and for, I will call it long-term investors. But I also think that long-term trading is probably too long-term for a lot of people, especially in tactical portfolio models. When I say tactical, I mean trend-following models. So an intermediate-term time frame is 6 to 12 months. A lot of this is driven by something called relative strength. There are numerous studies. If you just go and Google the phrase or the two words relative strength, you can find no shortage of research about how relative strength works, how the intermediate time frame is almost optimal or ideal for relative strength investing. And then from there, when it comes to risk management, there are many ways, as they say, to skin a cat. So some people like using ranking, which we use. Some people like using a certain line in the sand using support and resistance. We do that. Some people like using a moving average. We do that as well. So there's all kinds of different ways that you can determine how you'd like to implement an exit strategy in an investment over any time frame, by the way. But especially in an intermediate term time frame, there's definitely several ways to skin a cat on the sell side. And then the last one here is long term. So long term trading would be minimum of 1 year, 3 years or longer. So these are typically investors that are looking at a really long term chart, if they're looking at a chart at all. In fact, I think most long term investors probably don't look at a chart unless they just happen to pull one up, or someone else shows them a chart, or if they're just curious. I guess I'm just curious what this stock looks like on a chart, so I'm just going to look at it. But am I going to do anything? Probably not. So long-term investors are typically looking at fundamentals. They're typically looking at say the difference between the stock and its peers, the stock and its sector, the sector and its peers. They're looking at fundamentals such as price to earnings ratios, price earnings to growth ratios, sales, maybe earnings over time, things like that. So they're basically saying the quality of this company is such that I want to own it over a long period of time. And then if you want to get even deeper into the weeds, long-term value investors are typically looking for companies that are undervalued, relative to, say, the market. So the value, using different metrics, the value of that stock versus the market, or the value of that stock versus itself or versus its peers, and where they think it might be worth more. Obviously you don't want to buy a stock that has a low value, but then is expected to go lower in value for obvious reasons. So let's show a couple charts here. I know that if you're listening on iTunes or Spotify, that you're not going to see these charts. Feel free to go to our YouTube page or our website at libertaswealth.com to check these out. And now would probably be a good time to stop just for a second and say that, if you'd like a second opinion on your portfolio, if you'd like just to kind of have me take a glance at it and look at it and tell you what I think, I love doing that. It's a lot of fun. So no cost, happy to look at it, happy to have a conversation. Same goes for, and really more importantly, when it comes to your retirement plan. Everybody should have a retirement plan. I don't care how much money you've saved, whether that's you think it's too little or you're filthy rich. It doesn't make a difference. For people who are worried they haven't saved enough, or they're not sure if they have enough, or even if they know they have enough based on spreadsheets they've created, having a stress-tested retirement plan is an enormous advantage to you. Not to mention, it would help a lot with stress and peace of mind. So just because a spreadsheet over a linear analysis says that if you spend, 4% from your portfolio per year, but you expect 5% annualized, you should end up fine in the end. But, we all know the market doesn't work that way. We all knew that even a diversified portfolio that's very well put together doesn't necessarily go up 5% every year, 5, right? Sometimes it goes up more, sometimes it goes up less, sometimes it goes down, sometimes it goes down a lot. And especially if you're in the distribution phase of your life, which means you're retired, you're taking money from your portfolio, it is so much more important to avoid losses than it is to participate in gains and try to knock the lights out, or shoot the lights out, I should say. So if you'd like a second opinion on your financial plan, retirement plan, if you don't have one, then without a doubt, reach out to us, have an intro call, and we can just talk about what that is and how it looks and what our process is before we even move forward. And then if you're somebody who you feel like you don't need a plan because you've got so much money you don't need to worry about it, there's other things you need to worry about. There's things like taxes. There's the estate planning concerns, death taxes that might affect you and probably do affect you or will affect you. So there's lots of ways to prevent the money getting into Uncle Sam's hands, keeping the money in your family's hands. There's even some really, really neat planning we can do from the standpoint of tax savings while keeping the money in your family, while maybe even helping out a charity or charities that mean a lot to you. But I digress. So let's get back to the chart here. So Cadence Design Systems, just full disclosure, to stock we own in our clients' portfolios. It's in our moderate growth and aggressive models. And when you look at this stock going back in time, you can see this is a long-term chart. And the reason I'm defining it as long-term is because, first of all, every candlestick here is 1 month. And you're going to see, by the way, as we go through these charts, how they look very similar in that they're all candlestick charts. They all have a moving average attached to them because I put one on there. But every one of these candles is either an up candle, which means it's hollow. It's think hollow light. It went up, so it opened at the bottom of the candle, closed at the top, and then the wicks on the bottom and the top are as high or as low as it got that month. So again, the bottom is the open, the top is the close. The wick on the top is as high as it got in any day that month, and then the wick on the bottom is as low as it got in any day that month. Now, if it's a black candle, that means that it opened at the top and closed at the bottom. Think of it like it's full or it's heavy. So that's a good way to remember the difference between the empty or hollow candles and the dark ones. So when you see a black candlestick, that means it opened at the top at the beginning of the month, it closed at the bottom at the end of the month. And again, the bottom wick says how low it got that month, the top wick says how high it got in any day that month. So anyway, so this is Cadence Design Systems, over a software company over a long-term time frame. We're going all the way back to 2013 here, so 10 years. And you can see there's been several times here, 1, 2, 3, 4, barely, 5, 6, 7, 8, 9 times that it's closed below this longer-term trend line here. And so over the long term, the stock looks like it's in a pretty clear uptrend. In fact, if instead of using, say, a moving average, if you'd use just support and the resistance levels and picked higher highs and higher lows as your stop losses, you'd probably do better than if you used a moving average. But there's pros and cons to each, because using support and resistance levels might keep you in the trend longer, which is good. But if the trend fails or if it ends, you're also going to suffer more drawdowns on the way back to your sell stop, your exit strategy. So whereas a moving average will get you out sooner in this case, but you're going to see more whipsaws, which means you're going to be in and out a little bit more. So one is more conservative, but it requires more trading, and the other one is more aggressive, meaning you're going to suffer more drawdowns, but it might keep you in the trend longer. So this is a long-term time frame. This is somebody that would keep it for years and years and years because they just like the stock. probably for fundamental reasons. The next time frame here is intermediate term, so I'm going from longest to shortest this time. So again, this is more my time frame here at our office. This is a weekly candlestick chart, so every one of these candles is 1 week. So right here, this one open to the top, closed to the bottom, and the top of the wick is the highest day that week, and the bottom of the wick is the lowest day that week, but every candlestick is a week. I've got a 40-week moving average here, so in other words, a trend line that's very, very similar to the previous one that we just looked at on the longer-term chart, and you can see that if we own this, we'd be below water, as I like to call it, so below this trend line would be below water, and we can stay below water for a couple days, but if we stay below water for much more than a week or two, that's a problem. And really, the more you allow your investment to stay below water, in the case that you're using a tactical strategy like this, the higher the probability that your investment is going to drown, which obviously, as you can probably imagine, drowning as a metaphor is not a good thing, right? So you can see here it closed back above its trend line for just 1 week and then went right back below it. So it went through this time period here, this is 2022, for almost 6 months, we'll call it, where it just didn't do anything. It just kind of went sideways below water. Popped back up here, tried to compete with these old highs, and then headed back down again. And you can see just lower highs, lower lows, down till it's below water again. And then you have this huge candle. And we like big candles when they're out to the upside. We don't like big candles when they're to the downside. But a big, empty, hollow candle opens at the bottom, closes at the top. What that shows us is that there was a lot of movement, a lot of price movement that week, which might suggest that investors are more on the buy side of the stock. In other words, there's more buying enthusiasm. And the way trends work is the more buying enthusiasm you have, if there's an overweight or an imbalance of buying enthusiasm to selling enthusiasm, then price must rise. And if there is more selling enthusiasm than buying enthusiasm, then price must fall. It's I hate to say it, but it's simple supply and demand. It doesn't really matter what the news is. We had somebody ask us one time at a presentation years and years ago. He said, okay, Adam, I think I kind of get it, but here's my problem. If Apple sells a ton of Apple Watches this quarter, don't you think the stock rose because they sold a lot of Apple Watches? And the answer is you're close. But no, the reason the stock rose wasn't because they sold a record number of Apple Watches, let's just say. The reason it rose in price was because they sold a record level of Apple Watches, and because of that, people bought the stock. So I think so many times people want a story because we're human. Humans like stories. They want to understand the why. And what's amazing when it comes to tactical portfolio management, trend following, all this nerdy stuff that I'm looking at here, like relative strength, higher highs, higher lows, is when you look at these investments and you just look at a chart, it's a snapshot in time that tells you, are buyers in control? Are sellers in control? Or is there a stalemate? And by the way, that's important probably now to say, there is a such thing as trendless. When you see a flat trend line and a stock that's going up and down, just up and below that trend line here, where it's below water, above water, below water, above water, that's not really a stock I'm interested in. You might own a stock that after a long period of time, if it was in an uptrend, goes into a phase like that. And again, this comes down to your time frame in terms of would you keep it and hold on to it, or are you going to sell it? And again, that's all about your time frame, where you choose to put your line in the sand, meaning your sell stop, and then following your rules. Because if you have no rules, or if you change your rules, you have no rules. So if you have no rules, you have no strategy, and if you change your rules, you still have no strategy. So this is a weekly chart. Let's speed things up a little bit more. Now we're looking at a short-term time frame. So you can see here we're only looking at about 6 months, going back to April of last year for Cadence Design Systems. This is also a daily chart. This is a faster moving average. So now every candle is now 1 day. So you can see here's a big, huge hollow candle. That means it opened at the bottom, closed to the top. This little wick up here was as high as it got that day, and you really can't even see the wick on the bottom, which means it didn't really get much lower. It just went up that day. We can look at one like this black candle right here. Looks like in late July. So it opened at the top, closed at the bottom, but it got pretty high during that day and just failed. And you can see it didn't really get a whole lot lower. So on a daily short-term time frame, what we're looking at here is kind of, in my opinion, if I look at this chart, is similar to what we looked at on the weekly intermediate term chart. But you can see here there's maybe opportunities, one might believe, to try and capture shorter trends. But as you can see, the faster we get here, the more the whipsaws. So You're not going to be in the trend for nearly as long. You're looking to capture smaller gains and avoid losses at all times. I mean, that's what investing is all about, right? At least tactical investing is all about managing risk, avoiding losses. So let's move on to swing trading time frame. So I'm using stockcharts.com now to get some faster data. So this is a swing trading time frame. So now instead of 1 day candlestick charts, we're looking at 30-minute candlestick charts. So every one of these candlesticks, which I know it's really, really hard to see because I'm looking at 3 months here, but every one of the candlesticks in here is 30 minutes, and that's it. So somebody who is trading a swing trader, like I mentioned earlier today, they're looking at 1 to 3 weeks. So I wanted to show you 3 months only so you could see a longer time frame. I didn't want to make this so small that you couldn't see history, but you can see how this 3-week period right here, very clearly the trend is down. We've got lower lows, lower highs. We've got a declining moving average, a declining trend line, and the market just can't see, or the stock cadence can't seem to get above water and stay above water. But then that changes after the 21st of August, kind of spikes here, we get a little gap up, we get a spike, it pulls back. That's obviously a higher low relative to this low here. And now we're kind of off to the races. And every time it tries to get below water, it just can't. It's almost like it's buoyant per se. And so now we've got a rising trend line, higher lows and higher highs. So now we're in an uptrend. But we're in an uptrend on a swing trading time frame. This is not long term, right? This is swing trading. So as this goes down, now all of a sudden we peak here, beginning of September, we get below water, and we run into the same problem we ran into in the beginning of August. We've got lower lows, lower highs. The stock can't seem to get above or stay above water. We got gap downs here. That's no bueno. We've got further lower lows and lower highs, and then all of a sudden it looks like things are going to turn around. We've got a rising trend line, but then it fails, and it really cascades down here to this prior low, gaps up again, above, below, and back above the trend line, and now we've got a rising trend line, higher highs, higher lows. It consolidates sideways, and right here, about 2/3 of the way through October, it breaks down, and we're back into the problem of being in a downtrend again. So I've shown you time frames already, and I've got just one more to go here, the day trading time frame. But I've shown you time frames where you can be in a trend for a long time. We can be in a trend for weeks. I've shown you time frames where you could be in an uptrend or invested in a tactical portfolio management strategy for months, even if that time frame makes sense. But keep in mind two things. Not only do the trends increase in frequency up and down the faster our time frames get or shorter our time frames get, but the other thing I want you to keep in mind is I just happened to show you a stock that's been going up long term, okay? So I think it's important to know that if I were to pull another one up, and maybe I should have, I'm not going to do that today. We're already getting close to 25 minutes here. So, you can pull up any stock. Stockcharts.com is free. You go to stockcharts.com. You can change your time frame from 1 minute to 30 minutes to 1 day to 1 week to 1 month, and you can look at any stock you want on the planet, and you can pull it up and say, okay, here's how it looks on a long-term time frame, and what might look maybe really good recently on a long-term time frame might look terrible on a shorter time frame. So anyway, let's move on to that last time frame here. This is the day trading time frame. So again, similar to the swing trading platform, or not platform, but time frame, I wanted to show you 5 days of what it looks like to see minute by minute charts, because I didn't want to just show you the 1 day chart and that's it. So you can see here a daily chart. Again, day traders are typically either in or they're not, and they're out by the end of the day. So if a day trader looked at this start, it popped at the beginning of the day 5 days ago, and then immediately fell, and it pretty much stayed below water the whole time. This is just 1 day. Then it turned back around about 1:30 or so, 2 o'clock in the afternoon, finally found itself after 2 in an uptrend, so they might be in the trend at that point and holding it until the end of the day, then they'd sell out. The next day, they wake up in the morning, it gaps down, it's not even in an uptrend yet. To start the day, it's in a downtrend. Then it kind of turns itself around, finds itself in an uptrend for, looks like about 2 hours or so, 2.5 hours. Then it breaks down, and it spends most of the rest of the day in a downtrend. And I can just go through this. Obviously, I don't need to talk you through it, but you get the point. If I just look at 1 day, though, and I'm just looking at today, when I say today, I'm sorry, I'm recording this on Monday, the 30th of October. We're distributing it on Thursday. So this is the day of October 30th, Monday, and this is just one day. So the market opens up, cadence goes down, just barely touches its trend line here in this case, rises, breaks down again, then rises. Doesn't quite really hold below water here between 11:15, 11:45 a.m. Jumps again, but can't seem to get above this prior high, fails, and then spends the next hour below water. But then things turn around right around 1 o'clock, 1:15, and we've got ourselves an uptrend here from 1:15 all the way until about 3:30, just before the market close. And in the last 30 minutes of the market open today, the stock broke down, tried to get above water, could not, and it failed. So you can imagine, by the way, as you're building a trading strategy, and anybody who builds a strategy needs to test it. They need to use filters and things of that nature. So a filter you might use for a day trading strategy is to not place a trade just because it went up above that trend line for 1 minute. 1 minute is not a trend, right? Some day traders might disagree with me, perhaps, but in my opinion, if I were day trading, which I don't, but if I were, I would probably want to see any investment above its trend line. And by the way, the trend line is another decision. You want to go over what period do you want to have that trend line smooth things out. And so in this case, this trend line kind of starts to come up here. We see it's above it, 1, 2, 3, 4. Maybe I wait 5 minutes before I jump into the trade. Whereas some people might want to get it on the first minute, and then if it doesn't work out, they're right back out again. So you can see here, back at, say, 10:35 in the morning, this morning, it went above it for 2 minutes, 3 minutes, then 4 minutes, then it was below it at minute 5. Back above it the very next minute for 2 minutes, then back below it again, 3 minutes later, 4, 5, 6 minutes back above it, 7, 8, 9, 10 back below it. So you get the drift here. The faster your time frame, the more whipsaws. The faster your time frame, the quicker your time frame, you're going to spend less time in the trend. The faster your time frame, the more whipsaws, meaning the more times you're going to get out and back in again, which can cause what's called slippage. It can cause a lag in performance. But probably the most important thing is the shorter your time frame, the more you got to be paying attention. You really have to, especially if you're into day trading or swing trading, you have to enjoy this stuff. But I guess that would be true for any time frame, actually. So before we close out here, I want to share a couple little tips with you. One is, some of you might be thinking, well, what if I use one time frame and then use a second time frame to trade? You could do that, and it's okay to conduct analysis over multiple time frames. In fact, some of the best traders I know do that. Short-term traders, that is. So an example would be checking a slower time frame, like say an intermediate term time frame, to see if the longer term trend is up before investing in, say, a short-term investment strategy. So, or you might use the short-term time frame to find out, is the investment in an uptrend, before you go into a faster time frame, say like a swing trading time frame, because you want to see what's the bigger trend here. And if the bigger trend is up and if it's strong, then I'm almost stacking the deck in my favor to be in a better, stronger trend on a shorter term time frame. So nothing wrong with that. However, you should not change your risk management, meaning your stop losses, sell strategy, across multiple time frames. So for example, if you've got an exit strategy that you initiated at the end of the week, so the strategy is, I'm going to sell this investment or any investment inside my portfolio if it crosses below a certain line in the sand at the end of the week, but then you go and let's just say it closes below that line in the sand, and then you go and look at a slower time frame and you say, well, I'm going to look at the longer time frame, and maybe I'm going to move my stop to a new trend line or a new point of support or resistance, or both, because I want to see what happens here. I want to give it some more time. That's a huge problem, and the reason for that is it falls into all kinds of different behavioral and cognitive biases. So here's an example. This is Caterpillar. It stops at the end of the week. You might want to give it a day after that, 1 day, maybe 2 at most, to see if it can recapture that line in the sand. Maybe Caterpillar went down because the market's going down. It might not even be so much Caterpillar's fault. Or, there have been several times in the past where, like, for instance, the first one that comes to mind is the BP oil rig that blew up underwater in the Gulf of Mexico. BP, has this issue, and all the oil stocks go down. So if Marathon's down that day, is it because Marathon's a bad stock? No, not really. It's just the whole oil sector is getting hit. So that can happen with a sector, it can happen with an industry group, it can happen with an asset class, it can happen with the whole market overall. So it's the whole baby and bathwater thing. So here, Caterpillar's been going down right along with the market. You can see here we've got a trend line that's pretty high, and so it just happened to close here. You want to give it a day or two, fine, no big deal to give it a day or two, but beyond that, you can't press your luck, because here's an example. When you slow your time frame down and you say, okay, well, I'm going to slow it down to a long-term time frame now. I'm going to go down to a monthly chart. So now your stop loss is at, say, 210-ish, and now you've got a whole lot more loss that you have to capture if this thing continues down. Now, you might be thinking to yourself, well, yeah, but what if it doesn't go down? What if it goes up? Well, sure, that's fine, but as soon as you let me know how you found out it's going to go up, you let me know, and I'll put you on payroll and pay you whatever you want to help manage our portfolios here at the office. But we don't know. Nobody knows what's going to happen tomorrow, next week, next month. So what happens is, and the reason why people have a tendency to slow their time frames down and lower their stop losses or put more cushion between their risk management, is because they've been hurt in the past by selling, and then the market came right back, or the investment came right back. So for instance, maybe right here, look at this Caterpillar, it went down, it closed below that trend line that month, and so you stuck to that time frame, you stuck to your rules, and you sold it, but then all of a sudden it screams back the next month, and you're thinking, oh man, if I'd just held on to it, I'd be fine. So next time you don't sell it, and let's just go back in time and say it's here, so next time you don't sell it, it crosses below, and you hold on to it, then it goes down here, and you say, well, I'm going to wait till it comes back above it or close to it, then I'll sell it. But it doesn't quite get back to the line, and it keeps going down. And you say, well, now I'm going to wait till it get back to here before I sell it. And in this example, it actually did come back at the end of the day, but it would not take me 5 minutes to find you tons of charts that don't come back for days, weeks, months, years, or ever for that matter. So risk management, protecting your portfolio is so important, again, especially in a tactical portfolio. And by the way, when I keep saying tactical portfolio, what I mean by that is there's basically two big different ways of managing portfolios. There's tactical, which is trend following, where you can get in and out of a stock or a bond or an ETF or a fund or anything, and it's based on trend following essentially. And by the way, it's not trend prediction, it's trend following. There's a difference. And then there's strategic portfolios, which they're like static. They stay in the market. Now that what the investments inside a strategic portfolio might change depending on relative strength and, say, a ranking system. I always like to say it's like investing in the playoff teams and avoiding the rest. But that's the difference between trend following and strategic, is the fact that a strategic portfolio will stay invested in the highest, best relative performers. But if the market's tanking precipitously, we would still own the highest relative performers, but that would be the cleanest dirty laundry. Whereas in a tactical portfolio model, it's a lot more conservative in that it will take and cut bait on even those relative winners, because below a certain absolute line in the sand, we're not interested in owning the investment anymore. So we manage both types of portfolios because they both work at different times in different markets, and we really don't know which one's going to work the best until after the time period's already passed. So we find that it makes a lot of sense to combine the two strategies, strategic and tactical, into many portfolios, unless, of course, you're really young. It probably makes more sense to stay more strategic, stay in the market, buy more shares when it's cheaper kind of thing. You got a lot of runway ahead of you. Try not to overmanage the portfolio, if you will. So, if you're in your 20s, even 30s, you probably don't need to be so tactical with your money. But anyway, I digress. So that's an example of using two different time frames for exit strategies or risk management, and why it doesn't make sense to do that, and how it can really hurt you. So, in closing, I think it's really important to make sure you understand yourself, know yourself, who you are, how much volatility can you handle. I think before you start investing on your own, you ought to know how much time you have at any given day to manage your portfolio, and don't choose a time frame that's too fast, as it's going to require too much time and too much trading. The next thing here is knowing which cognitive and behavioral biases to which your personality is subject to or sensitive to, as well as which types of biases can be fixed and which can't. There are several biases that you can really train yourself to get better at, but there are many biases that you can't. It's just who you are. It's intertwined into your very being, and the only thing you can do is know those biases exist and try to recognize them when they come up. And then again, as I mentioned earlier, have rules in place to make sure you're following rules to keep you from using or allowing your brain to use those biases against you. And then last, to be a successful investor, you got to have two things. You have to have the interest in this stuff, so the interest in the subject matter, and you have to have the time to invest in doing the research and managing your retirement portfolio. And what we found is when people don't have the interest right off the bat, you're not going to spend the time on it, because why in the world would you spend some time on something you don't really enjoy? The second thing is, even for the people who have interest, oftentimes they just are busy doing what they do for a living. They're busy at work making money. They've got a family. They're trying to be a good mom or dad. They're trying to be a good husband or wife, a good partner, and they just don't have time to do this. So even though they enjoy it, they don't like the results because they aren't putting the kind of time they need to in it. But again, there are rare circumstances where people have the time, the interest, they put that time in, and they can see good results. So with that all being said, let's go ahead and close out again for the day for our first Nerd-vember of the month and of the year. Feel free to share this episode with your friends and family, and if you'd like to discuss your personal situation further, remember that you never ever have to be a client to ask a question. As mentioned earlier, if you'd like to set up an intro call to discuss your financial situation, or if you'd like to get a second opinion on your retirement plan, or if you don't have one, please by all means reach out to set up an intro call. You can head over to libertaswealth.com, click on that button that says click here to get started, and then be sure to subscribe on iTunes, YouTube, Spotify. And remember, you can sign up at libertaswealth.com to not only get these updates for videos and podcasts, but you'll also get access to the screencast videos and articles that we send out to our clients, delivered as soon as they're released directly to your email inbox. So be sure to do that. And then you can follow us on Facebook at facebook.com/Libertas Wealth. I'm on Twitter at Adam Koos, and I'm also on Instagram at Adam D. Koos. That's Adam D. Koos. So thank you again. And as I always say, there's thousands of podcasts out there. You chose to give hours a listen today. Thank you so much for joining us, and we'll see you next time.
Thank you for listening to the Cash Podcast with your financial surgeon, Adam Koos. To see any charts or images that were mentioned in this show, or to check out additional articles, videos, and other educational resources, head over to libertaswealth.com.